the financial markets basically are the platforms or those systems that facilitate the exchange of financial assets, the facilitation of capital formation. So the financial markets are very much important and needed in order to facilitate the capital formation. These financial markets are vital for the efficient allocation of resources in an economy. Hello everyone, I am Nikhilavati S, Faculty of Commerce, Vidhyaashram First Grade College, the Temple of Excellence, MYSURU. I welcome you all for the sessions on the subject Financial Markets and Services, and we are in the fourth chapter, that is Financial Markets and Instruments. So as we all know, the financial markets are one of the important component of the financial system in India. So the financial markets are nothing but the platforms that allows the people to trade in the financial securities. So it's just like a marketplace where the things are bought and sold. So here the financial market is a platform where the financial securities are bought and sold. So let us see more on what are financial markets here. The financial markets basically are the platforms or those systems that facilitate the exchange of financial assets, and these financial assets may include stocks, bonds, currencies and derivatives. So here the financial securities are traded in the financial market. So it consists the examples, for example we have NSE or BSE, that is National Stock Exchange or Bombay Stock Exchanges, where various financial securities are bought and sold or traded on a daily basis. So here we have stocks. So stocks are the shares of a business. So here, and the bonds are the debt instruments. The currencies are traded in the forex market, where the different countries' currencies are traded in order to fix the exchange rate, and the derivatives are the contracts like futures and options. They are called as derivatives because they form or their value is derived from the underlying asset. Say the future contract's value is derived from that particular asset for which the contract is made. So here the financial market act as a medium for buyers and sellers. Buyers and sellers of whom? Buyers and sellers who trade the financial instruments and ensuring liquidity and price discovery. So it's not just a medium of or a platform which allows the traders to trade in the financial securities, but also it acts a major role as a price discoverer. So price discovery is all about fixing or the determining the prices of the shares and various securities that are traded in the financial markets, and this price discovery depends on the demand and supply of that particular financial instrument. And also it is important to ensure the liquidity, that means the ability of the financial asset to encash or convert it into cash. Next is, these financial markets are vital for the efficient allocation of resources in an economy. So why these financial markets are important? Because it is important as they try to mobilize the funds or the savings, or they mobilize the money from the savers of the money or where there is surplus towards a productive investment. So that's why they make the efficient allocation of the money or the finance that is available, and it is very important for the economic development as it is invested in the productive activities and provide opportunities for investment and fundraising. So it's nothing but the stock exchanges are existing to provide the opportunities and for investment and fundraising, especially for the corporations. Coming to the financial instruments. So as we discussed, what are traded in the capital market or the financial market? It's the financial instruments. So let us see what our financial instruments are. The financial instruments are contracts or documents that represent a claim on an entity's financial values. So these are the documents like derivatives or the certificate of deposits or any kind of document of shares or debentures which can have a claim on the company's financial value, and they act as vehicles for investments and borrowing. So using these financial instruments like bonds, shares, debentures, the people can make investments and take the borrowings. Then they facilitate the transfer of capital as well as the risk. So it is not the capital that is transferred from the investors to the company or the corporation, but also the risk. So for example, it includes stocks, bonds, derivatives are the various financial instruments that are traded. Next we have is different types of financial markets. So what are the types of financial markets we have? These consist of the money market. So it is called as money market because it is whatever the securities or the financial instruments traded in this market is easily convertible into cash. So they are highly liquid and with low risk, where these securities or the financial instruments carry the maturity period of less than 1 year. Next we have is capital market. So here the capital market, as the name itself says, it is to raise the capital. So the meaning here is to raise the long term funds for the businesses. So whatever the securities having the maturity period of more than 1 year, these include shares, bonds, debentures, that securities are traded in the capital market. So next is foreign exchange market we have. So here is a market where the foreign currencies are traded. So next we have is derivatives market. So derivatives are the contracts like futures and options or swaps which carry a value which depends on the value of the underlying asset, either say for example on the movement of Nifty or the movement of Bank Nifty, etc. Next we have is the types of financial instruments. So let us see what are the types of financial instruments that are traded in the financial markets. So based on the ownership, we have equity instruments. So these equity instruments generally refers to the shares or the stocks of the business organization, because these instruments give an ownership right for the shareholder. Say for example, if a share holder owns 10% of the shares offered. Say for example, a company offers 1000 shares. If a person buys 10 shares or 100 shares, he holds 10% of the ownership of that particular businesses and has a claim on the business's assets. So if he owns 10 shares, he has 1% of ownership share in that particular company. So it gives the ownership right. That's why it's called as equity instruments, which give the ownership as well as the voting rights for the shareholders or the instrument holders. Next we have is debt instruments. So debt instruments here are the securities which are used in order to issue to the investors for the money lent by the investors for the company. So here they are entitled to get, the investors who have lent the money are entitled to get the interest on their investment. That means the interest for the loan that they have lent to the organization. So these includes various kinds of bonds and debentures. Next we have is hybrid instruments. Hybrid instruments means those instruments which carry the features of both equity instruments and debt instruments. So these can be the preference shares, where they can be the shareholders of the company, but they won't be having voting rights, and they are also entitled to get the regular dividend, just like interest that is paid on debt. So that's why they carry the features of debt instruments. They are preferred before equity shareholders, and they can claim the dividends payable on a regular basis. And based on tenure, the instruments can be divided into short term and long term. In short term instruments, here are those financial securities for which the maturity period is less than 1 year. It includes treasury bills, certificate of deposits, commercial papers, etc. Next we have is long term instruments. Long term instruments are those securities for which the maturity period is more than 1 year. So moving forward, based on functionality, we have primary instruments and secondary instruments. So in primary instruments, these includes those shares which are issued for the first time. Say for example, it includes IPO, that is initial public offering, where the shares are issued for the first time in the primary market. Next, in the secondary instruments, those instruments which are already existing and listed in the stock exchanges, just like the shares of Infosys or L&T or Wipro are traded. So where the shares of existing company that are already listed in the stock exchanges are traded. This includes stocks, bonds, currencies, derivatives, etc. Again, based on the market type, we have cash instruments and derivative instruments. So this cash instruments refers to the stocks, bonds, debentures, whereas derivatives refers to the options and futures contracts, which are not based on the amount or the cash investment, rather it is a contract that is made for a future date. It based on the commodity what they wanted to buy. Moving forward, let us discuss the role of financial markets. So why the financial markets are important to an economy. So as a component of financial system, why we need financial markets in our country, or why the financial market should be a part of the financial system. So that can be displayed as this, where it includes the facilitation of capital formation. So the financial markets are very much important and needed in order to facilitate the capital formation. So the capital formation is not that easy, because they need to raise a good amount of income or the investment or the capital that is needed to run the business, to make a startup, or to run the business, and also to carry out the or expand the business. So for this capital formation, the financial institutions may offer sometimes, but for every organization it is very difficult to raise the capital from the financial institutions. So here the financial market plays a greater role here by mobilizing the savings of the individual investors as well as the investment of the financial institution towards this capital formation and investing that into the productive activities, that too for a longer period of time. So in order to raise the long term capital, we need financial markets. Next, financial market is important for efficient allocation of the resources. That means the money that is flowing in the country, in the economy, is to be, it is important to be allocated on a productive purpose. So these, capital markets or the financial markets pool the money from the investors, and they invest in good performing stocks, or these investors are investing their amount on the good performing stocks. So in the direct way or the indirect way, here the money is utilized towards the developmental activities, towards as a capital for various business corporations, and it is used for infrastructural development, to lend loans to other businesses, etc. So next we have is price discovery. So capital market or the financial markets are also act as a price discover, and that price determination depends on the demand and supply for that particular share or the financial instrument in the market. Next is the liquidity provision. That means the financial markets are also providing the option of liquidity to its investors. So it's not that it is longer term and the investors cannot withdraw their money. So whenever they want, they can sell their stocks, they can sell their financial securities, then even before the maturity date, only except certain instruments which have lock-in periods. So they can sell it whenever they want, and easily the money is also, we have a very good digitalized system and the financial system where the sold amount is also credited to the bank accounts of the investors within 3 to 5 working days. Next is reduction of transaction cost. So nowadays, due to the advanced technology, and particularly the apps like Upstocks, Grow or Zerodha, they offer the minimal charges for investing, buying and selling of these financial securities. Next is the risk management. So through offering the mutual funds, even the insurance funds and all, they help for the businesses for managing risk of the financial needs, as well as they help the investors by showing like what are the low risk funds, what are the high risk funds, etc. Now let us study the functions of financial markets. So what are the work that is done by the financial markets? These includes mobilization of funds, that means the movement of savings from the individuals or the financial institutions, especially from those people who have surplus amount of money. So that savings is bought towards a productive investment. So there is a movement of money that is happening from the individuals or the financial institutions or various other corporations towards a productive investment. Next is facilitation of trading. That means the financial markets are also providing a platform for trading. That means here the investors particularly, they can buy and sell the various financial securities. It does not only bring investment to the businesses, but also because of the trading, the investors can earn lot of money. So it's a facility that the financial markets are providing for the investors. Next is encouragement of investment. Through the diversified financial securities like stocks, bonds, derivatives, debentures, options, futures, even the foreign currencies, commodity market, these financial markets are giving lot of investment opportunities like mutual funds, etc. That too at the large cap funds, the mid cap funds and the small cap funds. So they are giving the opportunity for the investors to make investment and encourage the investments among the savers. Next is the economic indicator. So the performance of the financial market is one of the main economic indicator of any economic growth in the country. Say for example, a bullish trend of the financial market indicates a positive economic growth of the country, whereas a bearish market indicates there is an economic slowdown in the country. So it depicts the economic status, economic stability of that particular nation. Next is promoting innovation and growth. So due to the amount that is able to be raised in the capital market, the companies are able to invest more in innovation, creativity, etc. They are able to adopt themselves into new technology. Because that they have the opportunity through these financial markets, they are able to raise good amount of fund, particularly the top performing companies. So raising money for them, it's not at all a problem in the financial markets. Next is global integration. For the global integration of the technologies, the business standards, and also the economic growth, it is important that the financial markets play a major role. So this was regarding the financial markets, the various types of instruments that are traded in the financial market, the role and functions of the financial markets in a country. Hope you all have understood. Thank you.